Okay, let's just go starting with the okay, here's the plan of attack. I'm going to quickly go through the lecture notes that were supposed to be the lecture for today, which is a couple more topics for chapter 10. And then I will zero in on the Excel files from the homeworks. And after all of that, and we'll quit sometime between 6:30 and 7. And then we can have a liquidity seminar, or maybe even get a hamburger. I need to do that, but I don't know if anybody wants to do that or not. But here's somebody's cell phone. Okay, this is there's two more topics in chapter 10 that we need to cover. And the first is just to reiterate or speak a little bit more about the cap rate and what's called direct capitalization, which is, the shortcut that we've already been applying, even all the way back at the beginning of Module 1. But now you have a little more depth of knowledge, and let's revisit this a little bit and understand it a little deeper. And the other question is, we've talked about valuation, but we haven't actually talked about an investment decision rule. So you get a certain value of an asset. So what does that mean in terms of whether you should invest in it or not? So we do have a very famous, very elegant and beautiful investment decision rule that never fails us, net present value. And so we will, I want to just quickly talk about these two topics. And then, they were in a position to do homework 3, but we actually got a backlog here of about 3 homeworks that we have, that we can talk about. So see what we get in, see how far we get into this. So the whole idea with this direct capitalization is we skip the multi-year forecast and we just divide the upcoming year by the cap rate, and that gives us our value. In other words, we replace this big long formula here and all of this 10-year Excel pro forma that you've done on the homeworks and that everybody does, with this little tiny formula here that's so much simpler, and with this little tiny analysis here, and really you can do it on the back of an envelope. You don't even need Excel to do it. So that's very nice. It's a shortcut. The thing is, I want you guys to understand, partly even just mechanically or formally, what's going on here. And I think to do that, I'm actually going to move us back to a numerical example that was in the previous lecture that I covered on Monday in a different context. So maybe this will illustrate the point. Remember this example here, where we said that, there's a property that's got $1 million of net cash flow in the first year. You can easily observe that. And the property's worth $10 million in the asset market. We can kind of observe that. But there's two different ways I could package this or present it. I can project it as the cash flows are going to grow at 5% per year, or I can project it as the cash flows are going to grow at 1% per year, and then sell it at the same multiple as we buy it at. And I can still get the same present value of $10 million by simply discounting the 5% growing one at 15% while I discount the 1% growing one at 11%. And I'll get the same $10 million value. So in terms of paying it in a way that's nicer and more cheerful for investors, would you rather spend $10 million and get 5% growth and a 15% return, or would you rather spend $10 million and get 1% growth and an 11% return? So I'm gonna put on the rose-tinted glasses and present it as, well, this is, you're gonna get 5% growth and a 15% return. That's the, I was using that to make the point about how people can make these mistakes in the discounted cash flow model, and the mistakes cancel out each other, and so they're relatively hard to observe, the mistakes. But now I want to use these same numbers, since you're familiar with these numbers a little bit, to demonstrate the essential difference between the cap rate and the discount rate. So let's imagine now that instead of this being one property that I'm presenting in two different ways, it's actually two properties, and these are realistic cash flow projections for those two properties. So property A is the one that's has cash flows that are growing at 5%. They really are. And property B has cash flows that are growing at 1%. That's realistic. Now let's suppose that both of these properties are of the same risk. So therefore, the opportunity cost of capital for investing in either of these two properties is the same. Right? Because the opportunity cost of capital is the risk-free rate plus the risk premium that reflects the amount of risk in the investment. And we're assuming the amount of risk is the same in these two properties. Therefore, the opportunity cost of capital is the same. Therefore, the discount rate is the same, because the discount rate is the opportunity cost of capital. And let's suppose that the correct discount rate is the 11% one. Okay, so how would this look in terms of in terms of cap rates and discounts and so forth? So property A has a growth rate of 5%, right? We'll call it G. And property B has a growth rate of 1%. Both of these have an opportunity cost of capital, which I label R, of 11%. So, what's the value of these two properties? So the value of property A, we'll call it V sub A, is what? Just conceptually, or just in terms of the numbers that are up there, how do we compute it?
1 by cap rate, which is 6% for property.
Okay, but more fundamentally, what you're doing there, what Fami is telling me to do, is to take the actual cash flow projections of property A and to discount them at its opportunity cost of capital, which is 11%. Now, I could write that out in a big long formula, or because of the
You have an annuality with growth.
I'm sorry?
You have an annuality with growth.
I'm sorry?
You have an annuality with growth.
That's right. It's that's right. It's a constant. It's actually a constant growth perpetuity, or it's a constant growth annuity with a constant multiple future value, right? So it meets the regularity requirements of just mathematically. We can collapse that big long formula into a shortcut, which is that it's the first period cash flows divided by the discount rate minus the growth rate. So for property A, that's, it's $1 million divided by the discount rate minus the growth rate, which is so property A is worth $16.7 million. We're discounting it at 11%, the opportunity cost of capital. That's the expected total return that an investor is going to get if they pay $16.7 million for that property. And they're getting that total return partly in the form of initial income, namely 6%. they'll get 6% of that back just in the first year with the $1 million, right? And then they'll get more and more each year. It's growing at 5%, and ultimately at the end they'll get, I don't know, about a lot of money at the end, right? Somebody had a question? Okay, so the cap rate for property A is 6%, right? But its discount rate is 11%. The total return that investors are getting when they buy it at 16.7 million is 11%. They're getting an initial income component right away of 6%. They're getting the 5% growth. Okay, property B, same formula. Same risk, therefore, same opportunity cost of capital, therefore, same discount rate.
But doesn't it say discount rate at 15%?
That was when we were trying to snow the investor and make them think that the property, that a $10 million property is going to give them a 15% return because it's going to grow at 5%, even though it wasn't really. But that was a different, I was using these same numbers to make a different point there. Here, we're imagining it's two different properties. These are the actual realistic cash flows for each of those two different properties. And both of the properties have the same risk, and I'm telling you arbitrarily, if they've got the same risk, then they have the same opportunity cost of capital. And therefore, they have the same discount rate, and I'm telling you it's 11%. Okay. I could have said it's the other way around, but let's assume it's 11% more realistic. Hardly any properties would give a 15% opportunity cost of capital. So,
Professor Gutman?
Yeah.
Sorry. Can you clarify what you just said about that 11% in the denominator, what it means to investors who are buying the property at 16.7 million?
it means when they're buying property A, which is giving them these fast-growing returns, it means that they are getting, well, they're getting an 11% total investment return in the form of the IRR. But only 6% of that is an initial immediate cash back in the first year. But then 5% of that is the growth, the long-term growth in their investment. In the form of both the growth of the operating cash flow and the growth of the value of the asset itself. Matt?
So discount rate, OCC, and IRR can be used interchangeably.
Discount rate and OCC. So there is a Stellar Forum thread on this. Who posted it? It was Allison. Read the thread. Her post is something like, what's the difference between yield and total return, or something like that, right?
Oh, that was someone else. I asked about the difference between discount rate, interest rate, cap rate, and all the rates.
Right. Allison had a good post, and there was I think it was Meng Ren. Anyway, there's been some threads on this, and please read them. But in essence, all of these things can be the same, but they're not necessarily the same. Okay, discount rate is just that. It's the rate that you're using to discount a bunch of cash flows. It might be right, it might be wrong, who knows? It might be meaningful or not. It's just mechanically a discount rate. IRR is just a type of return metric. It's a multi-period return. It is the discount rate that will discount a stream of cash flows to a specified present value. And opportunity cost of capital, so both of those are really just sort of mechanical definitions. Opportunity cost of capital is an economic construct. It actually means something in economics. It means, what you could alternatively expect to earn from another investment of similar risk. And therefore, if you use the OCC as the discount rate, then you will be getting the market value as the present value, assuming that your cash flows are also market expectation cash flows. And what else? And if you're using a single discount rate, over all the multiple periods of time, then it will be technically an IRR type of return. An IRR is a multi-period return measure. Okay, so, and all this stuff is explained in great depth in the textbook, but spanning more portions of the textbook than I felt I could assign as required reading, given the amount of time you guys have. But it is all in there, and I think I've referenced it a lot in my responses in the forum to Allison and Ming's questions. Okay, so asset B, $1 million initial cash flow, 11% expected return, 1% growth rate. So asset B has a 10% cap rate and worth $10 million. So both the assets have the same risk. They both therefore have the same expected total return, 11%. One asset has a faster growth rate, and they're both starting from the same initial cash flow. And therefore, the asset that has more growth in it is going to have a higher present value. But that's not because it's getting discounted at a lower discount rate. We're applying 11% as the discount rate to both of them. But it does have a lower cap rate because it's got more growth. Okay, so you see the difference between the cap rate and the discount rate. And you see how it's related to the present value. Okay. And I can get back out of that lecture. So the cap rate does not cause the value of the property, yeah.
So if there are like generally accepted cap rates in the market that you're witnessing for, and then you think that cap rate is applicable to a particular building, and then you more deeply analyze that building for what you think you could drive the growth out of it, you could then add those two together. And
so that's where you have to be very careful about just simplistically applying a cap rate from the market for a typical building to any one particular building. Because the cap rate, maybe asset B is typical in the market. 1% growth is typical in the market. And so you typically see cap rates of 10% in the market. And you have a particular building, and it's like the other buildings in terms of its risk. And that's fine, but your particular building is somehow able to generate 5% growth. And if you apply this 10% cap rate to your building, you see how wrong you're going to be, right? So that's why, and to guard against making that kind of mistake, that's why you do the 10-year discounted cash flow, where you explicitly look at the leases that are in the building, and you relate that to the market rents that it can rent out, and so on and so forth. Everybody understand? It's a really important point. Okay, so. And that's kind of related to this point right here, which is that the cap rate is not causing the value of the property. Cap rate is too simplistic. What's causing the value of the property is the whole full-blown, 10-year DCF. And then from that, we can back out what is the implied cap rate. And the cap rate is reflecting the market value of the property. It's not causing the market value of the property. What's causing the market property is the more complete total analysis that considers the total return, not just the initial income, and it considers the full horizon, the initial cash flow, the change in the cash flow, and the reversion at the end, right? So, this is just a numerical example of how you apply the cap rate. There's an even simpler, grosser ratio method of valuing properties, which is not even to base it on the net income, the NOI, but actually the gross revenue, or the GIM, the gross income multiplier. You're only going to use this to value properties that are where you really don't have much data. You can't even know, you can't even reliably observe the net operating income of the property. So this is really in the world of sort of mom and pop apartment, small mom and pop apartment investments where, you're looking at properties and you can pretty well estimate what you can rent the apartment out for because you know about the rental market, but you don't have a good reliable estimate of the expenses, the operating expenses of the property because maybe the seller, they claim that the expenses are so-and-so, but they can't really prove that to you. And so you're safer to really just base the thing on gross revenue. And just as with cap rates, you can observe what are the typical cap rates in the market, you can observe what are typical GIMs in the market. And that'll give you a back of envelope estimate. So the way that we're typically using cap rates as simply empirical evidence about market values. It's just a way of normalizing the price quote for a property. To quote the property price as a fraction of its initial income. And on average, that's going to give you an idea, the level of the market, where prices are at in the market. It's just we use an inverse of that. For some reason, I think because of the relationship between real estate and the bond market, people think in terms of yields. People use cap rates as the indicator of pricing in the commercial property market. And it's fine as an average indicator. And there's lots of surveys that are done to try to keep track of where these cap rates are, cross-sectionally across different types of properties and markets, between different types of real estate in terms of institutional versus, we'll call it mom and pop, the yellow versus the purple bars, and also longitudinally over time, how they're changing. Here's a picture of from Real Capital Analytics. That's one of our favorite industry partners because they really have been a very prominent company in compiling transaction price data for commercial properties in the US. And these are not drilling down into the real small mom and pops because they have a floor on what they look at of $2.5 million. And so just to give you an idea of both cross-sectional and longitudinal difference, I downloaded these numbers yesterday from Real Capital Analytics. So I'm tracking here Boston commercial, Boston apartments. So that's the orange line, the solid orange and the solid blue. We're going from 2000 quarterly up to today, more or less. And you see that, cap rates in Boston generally, well, you see how there was a secular decline in cap rate, the so-called yield compression during the first half of the previous decade. And then the big, when the market crashed, you see the upsurge in cap rates. And it may not look like much, but when a cap rate goes from 7% to 9%, what does that do to the value of a property?
30%.
All right, this is about 14, this is about 11, that's about a 30% drop in property price. It's huge. And if you borrowed 75% of the property right about here, then you just wiped out all of your equity. And your loan is suddenly underwater and the lender is very concerned. And and then we've seen the recovery in cap rates since then. Now remember, property value is not just the cap rate or the inverse of the cap rate, it's also what's going on here in the numerator. Maybe that's not staying at 1. Maybe the net operating income is also declining, or maybe it's increasing. So, interesting thing, just recently, I don't know if this is just a blip, but apartment cap rates had been consistently below commercial cap rates in Boston, and just recently it seems like they've equalized. And that's happened because of apartment cap rates suddenly rising. Maybe suddenly investors are thinking there's a glut apartments in the pipeline for Boston, so they're not willing to pay so much for apartments quite anymore.
Sorry, I have a question.
yeah.
Is that indicative of more value add, maybe B and C class properties trading?
The real capital analytics data, it would be more dominated, at this gross level, it's gonna be more dominated by probably, maybe not C class, but B class properties. If there are any B class properties in Boston, I think. This is the Boston Metro. So, then the pale blue line is Manhattan commercial, and the dashed orange line is Manhattan apartments. And these are like really low cap rates. Especially the Manhattan apartments are like the lowest, and they're down all the way down to 4%. Then I've got Atlanta commercial, and Atlanta apartment is, Atlanta commercial is dark dashed, and Atlanta apartment is light blue dashed. And these are high cap rates. I wanted to contrast a high cap rate city with a low cap rate city. So Manhattan apartments are at 4%, Atlanta apartments are at 7%. Again, that's a huge difference, right? Again, 0.04 versus that's the difference between 25 and 40. It's a double, apartment buildings per dollar of income are twice as expensive in Manhattan as they are in Atlanta. And then down here, the columns down here. The orange columns are office building cap rates in the cities of the major markets: Boston, New York, DC, Chicago, San Francisco, LA. Those are the big gateway markets where pricing is highest. So orange bars, and I don't know if you can read this, but 8%, 7%. So the orange bars are major market office CBD cap rates. The blue bars are just kind of the opposite. It's suburban office cap rate in the non-major markets. That's all the markets other than those big 6 cities. And it's suburbs rather than CBDs. And so those are much higher cap rates. Currently, the major market CBD office cap rates are about 5.5%, and the suburban non-major market cap rates are 7 3/4. Again, it's a huge pricing difference. And then last but not least, London. And this is central London office cap rates. And that's the pale blue lines that only starts in 2002, the pale blue bars. And they're currently,
Close to 5.
yes, slightly below 5% cap rate. So just to give you an idea of both cross-sectional and longitudinal difference in typical prevailing cap rates. This gives you a general idea of market pricing. You, at your peril, apply a general cap rate like that to any given specific property because of the kind of things we're talking about here. These are the corresponding price indexes of those same markets. And you see there's a lot of action here, a lot of there's both cross-sectional differences, and this is all pegging it to 100 in 2000. So these are relative differences over time compared to prices in 2000. But the prices, these values actually reflect the combination of what's going on in the numerator and the denominator. So what's going on in the space market in the numerator and the asset market in the denominator. That's a little oversimplifying because the cap rate also reflects the space market to some extent, the forward projection of the space market, because it includes this growth component. Right? So dangers of this kind of valuation. What I was just talking about, right? The difference between the cash flow profile of your particular property versus the average one in the market from which you're observing the cap rate. There's another issue, a bit more philosophical here, which is that if you just do this kind of ratio valuation, all you're doing is looking at the ratio of the typical market price to current income in the current market. And if you simplistically apply that to your property, And let's say the property does have typical income pattern, so it's quite appropriate and correct to do that kind of simple evaluation. Then what are you gonna get? You're just gonna get the market value of your property. That's fine as far as it goes. If that's all you're trying to estimate, that's fine. But what if you care about whether that market value is like overvalued in some broader sense or undervalued in some other? What if you care about the cycle? And just simple ratio evaluation will not, protect you against the cycle. It won't give you any insight by itself into where you are in that cycle. Like you can get by looking at, these kind of longitudinal perspectives, but if you do a full-blown multi-year DCF, it forces you to go through the exercise of trying to project realistically what is the cash flow that building can earn over the long run. And that cash flow, if you're honest about it, if it's realistic projection, that is a fundamental source of value for that asset. And if you do that carefully, what you'll find in the bubble period is that you'll discover when you do that sort of iterative analysis that I was talking about, you'll discover that the discount rate that you have to apply in order to get that realistic present value, the realistic going in cap rate from your multiple period analysis, if you're honest about the future cash flow projections, you'll find that discount rate looks really low. It's a really low discount rate. It's a really low opportunity cost of capital, a really low expected return on your investment, reflecting the fact that the current prices are really inflated, they're really high. And maybe that'll be a red flag that, because maybe we don't want to do this investment now. And if it's the whole market that's doing that, if you're in a bubble, if you're in a period like here, like here, cap rates, then you may not have much choice. You're gonna have to make that kind of investment that has that kind of realistic low going in total return. But at least you're doing it with your eyes open, okay? At least if you're working for a client, you can say, oh, look, this is your realistic return. Do you really want to put the money in now? And if you're in a situation where all of the asset classes are bubbled up at the same time, like in fact they were in 2006, 2007, then it's kind of, well, what else are you going to do? But they aren't always. Like in the 1980s, real estate was bubbled up, but stocks were not. And it would have been great to do this kind of analysis, which would have signaled to investors back then that you're looking at a really low return for your real estate investment here, and maybe you should put your money in the stock market instead, which in the late 1980s would have been a fantastic thing to do. So it's not the case that all the asset classes are always going to be bubbled up at the same time. Usually they're not, at least in history. So it's just, like I say, DCF analysis, think of it as an exercise, and it can be a useful exercise, or it can be a spinning your wheels exercise, or window dressing exercise. And, but it can be an exercise, whereas direct capitalization it's not an exercise. You're not gonna really learn anything from it. It's just a shortcut, quick way to get an approximate idea of how much the building's worth. Okay, so once we do this valuation, how do we make an investment decision out of it? And that's where we have the famous net present value. You've all heard of this, NPV, what it's all about. And so it's very simple. It's so simple that you can't assail it. It's the value of what you're getting minus the value of what you're losing. In present dollars that are adjusted for time and adjusted for risk. So you're like collapsing everything that matters into a single number. Very important that we make it apples to apples. We got to compare, the same kind of dollars with here on the benefit side with the same kind of dollars on the cost side. So they have to be all reduced to the same point in time, namely the present. And in doing that, you have to reflect the risk and how the risk may be different on these two sides. So you need to discount them using the appropriate opportunity cost of capital that reflects the risk premium that's appropriate for each of these. So then the rule is very simple. Maximize the NPV across all of the mutually exclusive alternatives and never choose an alternative that has an NPV of 0. Actually, this second rule is just a corollary of the first rule because you can In principle, you can always do a zero NP investment by just buying something at market value, or maybe something like, money market, but put your money in a money market fund. That's zero NPV. Not going to get much return, but it's also not much risk, and it's zero NPV. So you can always do that with your money. So even if I just had the one rule is to maximize your NPV across all mutually exclusive alternatives, then that alone would mean you would never do a negative NPV thing, because you can always do zero NPV. So if you're buying a property, then the NPV for you is the value of the property minus the price you have to pay for it. If you're selling the property, the NPV for you is just the opposite of that, right? An example, this thing is so powerful because it's based on, it's just common sense, right? But if we want to dress this up a little bit in sort of economic theory, we say it's based on wealth maximization. If you're maximizing your wealth, then you are applying the NPV rule, whether you know it or not, okay? If you're literally violating the NPV rule, then you are not maximizing your wealth. Right, so therefore, people that say, well, I don't use the NPV rule, I prefer IRR. Well, that's fine, but wherever your IRR rule disagrees with the NPV rule, you are not maximizing your wealth. Now, probably investors people who say that, if they're really successful, well, let's define a successful investor. How about the definition of a successful investor is an investor that maximizes their wealth? Then, any investor who is a successful investor is actually applying the NPV rule, whether they think they are or not, right? It's logic. So when an investor says, well, I prefer the IRR rule, or I use a simple payback ratio, that's great, but you're not a successful investor if successful investor is a wealth maximizing investor, unless you actually are applying the NPV rule wherever the NPV rule would disagree with your so-called favorite rule. And I think that that's often the case with genuinely successful investors. In a circumstance where their rule, payback within 5 years, disagrees with what NPV would say, they're actually figuring some way to do what the NPV would be telling them to do, right? Otherwise, they're really not maximizing their wealth. So, okay, enough of that. This is a rigorous logical proof, QED, right? Okay. So here's a cool corollary here that a lot of people don't think about, don't want to think about, which is that zero NPV deals are okay. Because everybody says, we only do positive NPV deals. So, we require our deals to always have to be, substantially positive. But, well, first of all, just why is a zero NPV deal okay? I mean, at first glance, saying zero NPV, I don't want to end up with zero. Whichever way.
You're still meeting your opportunity cost of capital.
Yeah, and the opportunity cost of capital is profit, right? So they're not zero profit. There are deals that are providing the normal or the expected or the appropriate amount of profit, the amount of profit that is justified or merited in the marketplace for the amount of risk that's there. Right, so that's the point there. Now, as long as we're talking about market values, remember, market values are not personal, private things. Market values come from the market. So the two sides of the deal, the buyer and the seller, dealing with a particular asset, the market value of that asset is not something that's particular to either the buyer or the seller. The market value of that asset is coming from the market. It's the most likely selling price, right? So from that perspective, not only is zero NPV okay, but actually zero NPV is the only NPV that will work for both sides. From the market value perspective, the buyer is looking at market value minus price, the seller is looking at price minus market value. Market value is in principle the same number for both of them. It's not, it's an objective number. Therefore, the only price that will allow each side to not violate the NPV rule is the price at which NPV will exactly equal zero, the price at which price equals market value. So what this means is that we would actually expect that the typical deal would be a 0 NPV deal. On average, the average NPV of all the deals is going to be 0. And one way to think about this is suppose we were dealing with stocks instead of real estate. Suppose we're in the stock market world. We're buying and selling stocks. In that world, does anybody ever talk about the NPV of the stock investment? No, because you're always buying stocks at what you know is the market value of the stock, and always selling it at what you know is the market value of the stock. So therefore, the NPV, everybody knows, it's always 0. So it's not an issue in stock market investment. You don't try to buy a stock that has a positive NPV and sell stock that has a negative NPV. In terms of market value, you may have your own opinion in terms of privately where one stock is going, and therefore you might want to make a bet on one stock or another. But there's no question in terms of market value, you're doing it at 0 NPV. And it's really the same in the real estate marketplace, except that remember we have these fuzzy values. So on average, yes, and the expectation is that every deal is 0 NPV. But any one deal at any given actual price may not be 0 NPV. But to the extent that it's not 0 NPV, the positive NPV that the one side is getting is exactly offset by the negative NPV that the other side is getting. Yeah.
Isn't it possible to have different cap rates for the buyer and seller? I mean, I'm sorry, not cap rate, discount rates.
No, not in terms of market values. The discount rates are opportunity cost of capital, and that opportunity costs always come from market values. So in the case of the opportunity cost of capital, that's coming from the capital market. And the capital market is giving you an objective, discount rate.
Right, but wouldn't your cost of capital differ between, like, if you're an institutional buyer versus some Joe Schmuck with poor credit rating, right? Like, your cost of capital would be fundamentally different.
So cost of capital actually applies to the asset that you're investing in, because that's where the risk is. And so, the short answer is no. And I think it's in this course that we kind of explicitly cover that. There's a part in the book that explicitly covers that. Think of it like this. Suppose I'm a really good credit risk. I've got a tremendous credit record. I never borrowed too much money. I always service my debts on time. And so banks will lend to me at a relatively low rate, 5%, let's say. Versus another guy who's got a bad credit record, and the banks won't lend him at less than, say, 7%. And we're both considering buying a particular asset. The value of that asset is greater to me because I have a lower cost of capital than the value of that asset for him because he has a higher cost of capital. Value of that asset is the value of that asset. It's what we can both expect to buy it for in the market or what we can both expect to sell it for in the market. The value of that asset reflects the opportunity cost of capital of that asset, not of me or of him. It reflects the risk that's in that asset, not the risk that's in a particular buyer or seller of that asset. So that's, I think, maybe a way to help see that point. Yeah.
I have a clarification question. So we recognize that when the NPV equals 0, that's fine because it's taking into account the profit, which is the discount rate that's baked into this, which is the hurdle rate, correct, that the investor wants to get off of this deal. They have a certain rate of return that they want to hit.
Well, basically, yes. In terms of that asset itself, you could think of it as a hurdle rate. Yes. Okay,
so in the IBET case, we know that the investors are looking for a 10.5% return on their investments.
Yeah.
And so would that be the hurdle rate equals the discount rate?
So that's a great point because the hurdle rate for a particular, and it very much relates to the previous question. The hurdle rate for a particular asset would reflect the opportunity cost of capital for that asset. But you can have, an investor can state a target hurdle rate that they want to meet in their investments. And what that means is Is this the first time I've drawn this picture? I don't think. So risk and expected return. This is a risk-free rate. This is the risk premium, right? So if I state that I have a target of 10.5%, what that means really, because I can't just like wish that I could get 10.5% from any given investment, right? The investments are going to give me the expected return realistically that is their opportunity cost of capital. And that's going to be associated with a particular amount of risk. So when I say I've got a 10.5% target, what I'm really saying is my target is to invest in investments that have a particular amount of risk. I don't really want to have this much risk, even though that would give me, well, if when I say that I'm simply saying I want at least this much, then maybe I also would be willing to take on more risk, but apparently what I'm actually saying is that I don't want any investments that are less risky than this. That's what it actually means in realistic practice when you put this in the context of the market that they're dealing with. So that's the way to think about that. But oftentimes people don't think of it that way. They forget about that you cannot separate return from risk in the capital market, in any capital market, including the real estate market. So, okay. Yeah, so people like to say that, we only do investments that give really big positive NPVs. So how can they sort of kid themselves if they're doing that? Well, one way is kind of the illusion that maybe you were kind of alluding to, which is to think that the opportunity cost of capital is the cost that you can borrow money at. But that's, yeah.
And I still want to follow up things since this is presentation.
Of course.
So I wasn't talking necessarily about the cost of borrowing funds, but it's an alternative investment cost, right? So it's like, well, if I can invest that same money into another investment, what is the opportunity cost of that?
But how would
What am I
that
giving
be,
up?
how would that be different for you than another investor? And what does that imply about the expected return to any given subject investment?
I think part of it is, let's say size. Size sometimes gives you access to different types of returns, right? So if I'm on a sufficient scale to be able to invest in a product that gives me, let's say 10%, and this guy can only invest in a product that can give him 8%, I would say that my opportunity cost of capital would be higher than theirs.
No, because again, it's not a function of you, it's a function of the size of those assets, the size of those investments, right?
Which you have access to.
Well, okay, I mean, so, maybe there's some investors that don't have access to, some types of assets that might be somewhere here on the spectrum, although, capital markets, especially in the US, are pretty efficient, pretty complete. You can probably find both risky and non-risky investments for investors of all different sizes.
Right.
Okay, so a lot of times people, ignore the actual opportunity cost value of land. They'll ignore search and management costs. They'll look at private information, which that can be relevant, but it's often not relevant for market, because market value is going to be based on public information. It may be relevant for investment value, right? And there is this separate conception of value called investment value. We'll be getting into that. And with investment value, you can have NPVs that are substantially positive. With investment value, you can have deals where both sides of the deal are getting positive NPV. Because one side has an investment value that's above the market price, the other side has an investment value that's below the market price. And if the low one is selling to the high one, they can both be getting positive NPV, right? And that's what a lot of the action is about. But we'll get to that later. So also, real estate markets are not so informationally efficient. People do make pricing mistakes. You can find situations where you can buy a property at above or below its market value. Be careful that you don't be on the wrong side of such a mistake. That's why you got to do your due diligence. That's why you got to do your homework. That's why this is not so simple and straightforward as buying or selling stocks. Unique abilities. not gonna really affect market value, right? It may affect your investment value, and therefore whether you want to particularly buy a particular asset or sell a particular asset. Choosing among alternatives also, if therefore the common thing is that any property is going to be presenting you basically with a zero NPV. Once you do your due diligence and once you ascertain the market value, and you're going to generally basically expect to buy properties at their market value, basically they all are zero NPV. So you can't really use the NPV criterion, at least in terms of market value based, to tell you which properties you want to buy or sell. So you gotta have some other reasons for knowing which properties you want to buy and sell. Well, obviously, one thing is this investment value issue, right? Leaving that aside for now, get to that in another chapter. But you may have macro or strategic reasons. And this is really, in terms of the homework 3 that was due for today, where you're trying to do the buy, hold, sell thing for those 6 or 8 IBET properties. You're really kind of looking for which properties are more of so you can't really expect to sell any of these properties for different than their market value, right? So which one of them are kind of more of a fit in terms of your portfolio, in terms of maybe your portfolio is overbalanced in one property type or one geography than another, or maybe you feel like that you have better abilities to manage properties in a certain situation than another. I mean, like for example, that Northwest Business Park, that property is in a distressed situation. It's in a difficult situation. In the property itself, half vacant, and the market that it's in. It's a weak market, and there's more supply coming into that market. That calls for somebody who's really good at managing those kinds of situations. And maybe IBET pension fund or galactic investment managers aren't particularly good at that, at least for an industrial market in Indianapolis or wherever it was. So maybe it does make sense to unload that one to a type of more specialized investor that really has those kind of strengths. And so that's the kind of just sort of common sense, really, portfolio strategic thinking. But then another thing is what I was previously telling you guys about. How about look at the profile of the returns in terms of how they're matching your interests and your strengths and weaknesses by looking at those performance attributes. So, and then you got the IRR versus NPV rules, and there's that debate that everybody always gets into, and you guys can read about that in the book. What I'd like to do now is to drill in a little bit with the actual homework trials. So let me pull up. Greenway was the first one that you guys did, and and you can all download the solution homework solution 2 file if you want to.
Can I just ask one quick question before you move into this? Going back to your comparison with real estate and the stock market, is there friction created by the additional transaction costs in the real estate market as compared to the stock market because it's being borne primarily by the seller rather than evenly between both parties?
I'd be careful about assuming that either side bears it asymmetrically because why would they?
Doesn't usually the seller pay the brokerage?
Maybe directly, but then wouldn't they just raise the price that much to cover that cost? So I think people usually talk about round trip costs and figure that both sides pay those directly or indirectly. And yes, there's a lot more friction in real estate transactions, which one of the ways that you deal with that is not transact so frequently. You have much longer holding periods, so you effectively sort of amortize those transaction costs over many years, so the impact on the actually achieved return per annum isn't necessarily much greater than it would be in the stock market. But what that means is, a lot less liquidity. You're more into it for the long haul, which is why the operational management becomes a lot more important. Because you actually are, with real estate investments, you are operationally managing those assets. With the stock market, you're not. You're totally passive.
And also you are a buyer and seller. You're not.
Yeah, typically you are not just a buyer. You're going to be also a seller. So from your perspective, also it's going to wash out as money points out. So So Greenway, is this R&D building, and, the kind of building that we talked about in the Milpitas example right at the beginning of the course in Columbia, Maryland, and, if you do a back of envelope direct capitalization, the case says that, the case gives you typical cap rates for industrial properties and for office properties. It doesn't give you cap rates for R&D properties. But R&D properties are kind of like a hybrid or a combination or a blend of industrial and office properties. So I kind of looked at the cap rates that they gave you in that table 1 for industrial and office properties and came up with a range of 9.5 to 10.5 for this property. So back of envelope, you could just apply these to the existing income, which is actually 1998, and you get a range of values there between 11.6 and 12.8 million. But if you apply it to the forward-looking next year's income, which would be a more typical way to apply a cap rate, it depends on what you think that next year's income is going to be. The Harvard case said to grow it at 3%. If that's realistic, then we're looking at a valuation between 12 and 13.25 million. If we think a more realistic growth rate would be 1%, then we're, those numbers there. So we bought it at 11.4 million in 1997, and it's only a couple of years later. But that's the back of envelope analysis. I did some, in order to blow this up into a 10-year discounted cash flow. And so we're kind of running this Harvard case a little bit on a higher octane than the case was designed for. The case was not really designed for you to do that much 10-year DCFs. It's more aimed at the back of envelope. So they didn't give you all the information you would need or would normally have in the real world to do a 10-year. But they did give you a fair amount of information, and using that information, you can do the 10-year DCF, and you guys can look at the detailed formulas here, but the way I've set up this spreadsheet, it's not super generalized, but it's a bit generalized so that we can change some of these inputs without having to go in and do open heart surgery into the individual formulas in each cell. So these are the Harvard assumptions. They said, let's assume that rents are growing at 3%, everything's growing at 3%, and so forth. Now, let's do that iterative procedure that we talked about, right? Remember, let me pull that up. Sorry. Sometimes the cursor just goes wild. Oops. Sorry, can you do that? So first step is set a realistic rent growth rate. Is 3% realistic? No, let's change it. What do you think? About 1%. If inflation is a little less than 3%, and if we've got 1 or 2% of real depreciation per year, then 1% would seem to be more realistic. But wait, before we do that, if we do the Harvard assumptions, we're going to come up, and the Harvard assumptions included that the discount rate would be 12%. And we're going to come up with a value that's a little more than 13 million. If we compare that to our direct capitalization, the back of envelope, then we're, somewhere in this neighborhood here. So So keep that in mind. That's probably, usually the way this happens in the real world is that bottom line number, that 13 million number is probably not too unrealistic. Remember I said that's the thing you can kind of observe fairly well. So, so let's make our growth rate 1% instead of 3%. And, how about a realistic terminal cap rate? Okay, so the going in cap rates are in the range of 9.5 to 10.5%. Ignoring any cycle, and actually 1999, we were kind of in the midpoint. There'd been clearly recovery from the crash at the end of the 90s. But no indication really that you were like at a bubble or something like that. And so it's probably pretty reasonable. And this property, let's say it seems to, nothing jumps out at me of having particularly weird vintage leases or cash flow pattern in it. So let's assume that kind of it's going to be typical of the kind of cap rates that we observe. And therefore, we would want the going out cap rate to be maybe a little bit above the going in cap rate. And the going in cap rate is between 9.5 and 10.5, so on average about 10. So maybe the going out could be, I don't know if the Harley case told you to do this, but I think it would, an appraiser might typically put it in at 10 and 50. Going in is 10, and appraisers like to have the going out maybe 50 basis points above the going in. However, remember the latest empirical analysis, we find that we don't have that much cap rate creep. So maybe let's make this, to be realistic, maybe make this a little smaller, maybe 10 and 25 dips. Okay, so that's going to be realistic. What next? Realistic discount rate. All right, well, I don't know if I put it in the homework or it's in the book or whatever, but risk-free rate plus 4% for institutional real estate. If you go more into the mom and pop part of the spectrum, then you do have a higher risk premium. This property is arguably institutional real estate. It's of a size and of a type and location and everything. And after all, IBA is an institution and they're buying it. So, and I think I said that the risk-free rates at that time in 1999 were about 5%. So, 10-year T-bond minus 1%. I think the case said the 10-year T-bond was like 5.8% or something. So at that time, 5% would be a good rate for risk-free rate. It would be lower than that now, but so that would suggest that our opportunity cost of capital here, our discount rate should be what? Not 12%. 12% is the rose-tinted glasses, making investors think they're getting more return than they really are. So we got to put in what? 9%. As a first iteration anyway. Okay. So now, compute the present value and check the consistency with going in cap rates. All right, so, oops. So we are getting a present value of over $14 million, $14.3 million. And that's a going in cap rate of only 9%. And our range of realistic going in cap rates is 9.5 to 10.5. So this is not consistent with the market evidence for market price. Furthermore, this going in rate is way too far below the going out rate. It's 125 basis points below the going out rate. Unless there's some reason for that kind of a gap or spread, then that's internally inconsistent. So we're going to have to iterate back. And what do we want? Where are we going wrong here? We need to somehow get a smaller present value here. Yeah.
I'm sorry, just real quick, for the risk-free rate of 9%, what did you, for the
risk-free rate of 5%.
Okay.
And risk premium of 4%.
Which was the 10-year T-bond with the yield adjustment?
Yes.
Okay.
You just said that the risk is inherent in the property,
Yes.
regardless of who buys it.
Mhm.
But you also said that there's a risk premium added to it. If it's institutional, it's 4%. If it's non-institutional, it's 6%.
Right.
That kind of is.
It's not the same properties. The properties that trade in the institutional marketplace are bigger, finer, more expensive properties than the properties that trade in the non-institutional marketplace. Now, there's a fuzzy line between there, and there's maybe some room for some arbitrage there, but,
By changing the growth rate, market rent is, growth rate for the market rent is 1%, but you didn't change the potential revenue for this property.
But I did, I think that's built in, that's baked into my formulas. Unless I've got something wrong here. I'm not gonna change the rent on the pre-existing leases. I mean, those are fixed, right? But,
Thank you, check that.
yeah,
It's still 1.6.
yes, because I think that's built into the pre-existing leases. My understanding is the existing leases have steps of 3% built into them. So the existing, I'm not gonna change that. That's my assumption that's contracting. But once you go out, forward into new leases that would be signed in the future, I'm using that 1% step.
So what you're saying right now is we've gotten it up to 14.3, but you're desiring to get it back to closer
Yeah,
to
because
13.
now we've got what we thought were realistic inputs, but we're getting an unrealistic output. So we have to iterate back. So one thing, so we're gonna look at our inputs and see where we're going wrong here. So one thing is, let's look at the capital expenditures, capital improvement expenditures. I've conveniently calculated them here. This is the CapEx fraction of net operating income, right? I just totaled it over the whole thing. So the capital expenditures as a fraction of NOI is only 10%. I said realistic there is 10 to 20% range. This is really at the bottom end of the realistic range. But I think we can realistically bump that up. So the simplest sort of shortcut way to do that, and you would want to be more careful in the real world, but as a first cut, it's going to effectively do our job for us, is to simply, let's add $50,000 a year of CapEx, just in terms of common area physical improvements. It doesn't matter whether that would actually be what it is or not. It's going to just effectively, put that into the analysis in terms of the cash flows. Okay, so now I've added $50,000 of CapEx every year, and now that's bringing my CapEx fraction of NOI up to 14%, which is just slightly below the midpoint in that 10 to 20% range. So I feel that's a little bit more realistic. And that's gotten my value down to 14 million and my going in cap rate up to 922, still too low. Too low of a going in cap rate, too high of a value, but we're getting in the right direction, yeah.
Two questions with that. One, when you're talking about CapEx being 10 to 20% of NOI, are you talking about all of the pieces in CapEx, including tenant improvements and leasing,
Yeah.
or just actual?
No, all the pieces of CapEx.
Okay, and then you just plugged in that 10.25 for the going out.
Right.
Why not just change it to the 9.25?
Because we've got market evidence, taking Harvard's word for it, that range of 9.5 to 10.5 really is, market evidence. Okay, so that's what I'm trying, and we need to anchor this off the real market.
So you're trying to get the going in cap rate off?
Yeah.
Okay.
And are we trying to get the going in cap rate to end up being equal to the terminal yield cap
No,
rate?
it's not so much that, we're trying to get the going in cap rate to be consistent with the market evidence, which I'm taking to be 9.5 to 10.5, as given in the case.
Okay.
And actually, I do know that those would be typical cap rates for that time and that type of property.
And the going in cap rate is just the cap rate as the last
It's the cap rate
NOI
that's
iteration.
implied, it's the cap rate that's implied by this pricing. And that's the problem. The price that we're getting here is too high, giving us too low of a going in cap rate relative to the market evidence. Unless there's some reason why this property really should have a weirdly low going in cap rate, and we're not being realistic here. So what else is the problem here? Well, one thing is, when I reduced the growth rate of the revenues to 1%, I also reduced the growth rate of the operating expenses to 1%. That's not, revenues would not keep up with inflation because of the depreciation of the structure, but nothing says that operating expenses won't keep up with inflation. So maybe I should make the operating expenses, I don't know, maybe not a whole 3%, because maybe that's even higher than inflation, but at least let's try 2% would, I think, arguably be realistic for operating expenses. And now, that gets us down to about 13.5 million, which is a going in cap of about 9.5, which is just scraping the bottom end of our realistic range. But still, I think a bit on the low side, and also a bit too far below our going out cap rate, and I'm kind of loath to make the going out cap rate lower. For one thing, that's going to backfire on us in terms of, we'll once again raise this and lower that, so chasing our tail there. So where's this leading us? This is forcing us to think about what's the realism, what's the realistic, cash flows that this property is really going to realistically generate, consistent with current market values. Matt?
Maybe you're going too easy on yourself in terms of your assumptions for your lease renewals and
Vacancies and things like that. What are we assuming there? We're assuming 70% renewal probability with a 6-month vacancy in the event of non-renewal. So the evidence is actually that there's not much good solid empirical evidence. The best evidence that I know on this is an MSRED thesis written about 10 years ago under Wheaton's supervision, Rebecca Asser. And they had a big database of a bunch of properties that CBRE was managing or tracking, and they found out, I think they got 60 or 65% here is the actual renewal rate. However, that was the renewal rate per lease. But the bigger leases, bigger square footage spaces tended to renew more at a higher frequency. And so if you count it on a per square foot basis, the probability of each square foot renewing was actually 75%. So this isn't too bad. And 6 months in between also I don't think is overly optimistic. But yeah, we could maybe shave a little bit off of there. Maybe, I don't know, add a little bit in there. What does this do for us? This is really, this is the way it works, guys. I think we're still a bit low on the CapEx fraction. We're at 15%, we've got the 10 to 20% range there. Let's maybe bump that up from 50,000 to 70,000. Oops.
If you believe deeply in your analysis for future rents and the numbers you're coming up with, is it plausible to then not believe the cap rate you're seeing in the market?
Ultimately, you could conceivably come down and really convince yourself that this property is worth more than the market cap rate evidence would suggest, and therefore probably than the selling price that the seller's offering it for. You might find a deal here. That's what I mean. That's why this kind of analysis can sometimes, find you a deal, either positive or negative.
Does that speak?
Because, pricing is not perfect in this market. There's inefficiency. But that's your last resort, right? You really got to convince yourself that your numbers are really tight here on the input side. And so we're getting now to something that's seeming pretty realistic. We're still a bit low here. But we're now within 50 basis points in terms of the spread between the going in and the going out. So we're at least within what the appraisers traditionally like to assume. And we've got a going in cap rate that's within the range of what the market evidence said. So, we could maybe stop here. I just wanted you guys to get a flavor for how this actually works in the real world. Except that in the real world, most people don't bother to do this much. They'll just take the, 3%, yeah, sure, and 12%, and they come up with the, present value. So we're getting a present value here that's, not very different from the Harvard number present value. Which was, I think, 1302 or something. So, that's the point. But now we have realistic expectations about, that's the other thing. It's a bit fuzzy, both the risk-free rate and the risk premium, and maybe this property is a little bit on the borderline of being actual institutional grade property. So I could live with let's say 9.25 opportunity cost of capital. And now it's, I like this one. Right, we're at almost 10%, almost the midpoint of our going in cap rate range. And the difference between the going in and the going out is now just a little over about 30 basis points, which is, not much cap rate creep. So I really like this now. So about $13 million, very close to the Harvard numbers, but in terms of the present value of the property. But a very different picture in terms of what the expectations are. So, yeah.
When you have a cap rate range, are you feeling more comfortable if you're finding yourself in the middle, like the way
Other things being equal.
Yeah, that's what I mean. Is like, if you're on the outer edge, do you still have an impetus to try to go further into the center?
Like in a case like this, I mean, I just know this property is like not a superstar of its class. It probably has to do with how old the property is already. And so I would feel a little uncomfortable about being at the bottom edge of that cap rate range. Columbia, Maryland is kind of, actually in those days, Columbia, Maryland was pretty desirable for institutional investment. But now it would be considered kind of a suburban market, and they're kind of out of fashion. But so anyway, there's other things that we would like to get into, such as the attribution analysis. But it's 7 o'clock. I have to get that hamburger, so we will close this off for now. But we'll have time. I'm feeling enough caught up. Not totally caught up. Enough caught up that I think we'll be able to cover everything. Either in class next week or recitation next week, and we're on the forum, right? So,
Yeah.